I am absolutely thrilled to have you here today as we dig into some really fascinating source material all about financial markets. If you've ever watched the financial news or even just overheard people chatting about the stock market, you've probably hit that wall of just totally intimidating jargon. Words that make you feel like you literally need a Wall Street degree just to keep up. Well, today, we're tearing that wall right down. We're going to take some of the most complex sounding terms in all of finance, specifically derivatives, futures, and options, and translate them into plain, everyday English. No crazy math, no confusing buzzwords, just a clear, easy-to-follow breakdown. Because let's be real, you've probably seen the hype. You're scrolling through social media and boom, there's a post from someone claiming they turned a few bucks into this massive, life-changing windfall using something called options. Or you hear traders casually saying, "Oh, I'm trading futures today." And it naturally makes you wonder, what exactly are they? Are they just another type of stock? Are they traditional investments? Why is everyone so obsessed with them? It is totally normal to feel a bit lost here. But the truth is, the fundamental ideas behind them are actually much simpler than you might think. Okay, so before we talk about futures or options, we gotta cover the big umbrella term they both live under. They're what we call derivatives. And here's your big aha moment for today. A derivative is literally just a contract that derives its value from something else. That's the whole secret. The contract itself, it's basically a piece of paper, well, a digital agreement these days, that has absolutely zero intrinsic value. It gets all its worth from another underlying asset. Both futures and options are really just different flavors of derivatives. So here's our game plan for this explainer. First, we'll decode the derivative. Second, we'll look at futures, which are kind of like a financial time machine. Third, we'll explore options. Fourth, we'll see why traders actually use them. And finally, we'll wrap up with the real risks and common mistakes. Let's jump right into part one, decoding the derivative, the actual foundation of finance. I mentioned earlier that a derivative gets its value from an underlying asset. Well, what's really cool is how tangible those assets can actually be. That's something else driving the price? Sure, it could be regular stocks or a big market index. But it can also be physical stuff, like a bar of gold, a barrel of oil, or a bushel of wheat. It could be currency, or even crypto. By connecting this super abstract word derivative to these everyday items, it just makes a lot more sense, right? You aren't buying a literal barrel of oil to put in your garage. You're just buying a contract based on what that barrel costs. Moving right along to part two, futures, the time machine. Let's talk about locking in the future. A futures contract is exactly what it sounds like. It's an agreement you make today to buy or sell something at a very specific price on a specific date in the future. Imagine you are totally convinced that oil prices are going to skyrocket in the next few months. You could sign a futures contract today that lets you buy oil at today's cheap price when that future date finally rolls around. If you're right, you win big. Your contract is incredibly valuable because you get to buy cheap oil when everyone else is paying top dollar. But if oil prices tank, well, you're stuck paying that higher agreed-upon price, meaning you take a loss. To really understand this, let's look at why these were even invented in the first place. Picture a wheat farmer. He is terrified that wheat prices are going to crash before his harvest is ready, which would totally wipe out his income. Now picture a big bread company on the other side. They're terrified that wheat prices are going to spike before they can buy what they need. So what's the solution? They shake hands on a futures contract. They agree on a price today. Boom! The farmer has a guaranteed sale price, the company has a guaranteed purchase price. Both sides manage their risk, and everyone gets to sleep at night. But let's be real about modern markets. Today, the vast majority of people trading these contracts have literally zero intention of ever taking delivery of 1,000 bushels of wheat. They use futures for speculation. They're just trying to profit off the price swings. And the reason futures are so popular for this is leverage. Leverage basically lets you control a massive amount of an asset with just a tiny bit of your own cash up front. But a quick warning here. While leverage can seriously magnify your gains, it will magnify your losses just as fast. All right, let's pivot to part three. Options, the right to choose, and the flexibility they bring to trading. Okay, if you remember only one thing today, make it this. Options give you the right, but absolutely not the obligation to make a trade. This is a massive distinction. With a futures contract, you are locked in. You signed the agreement, you have to follow through. But an option, it's exactly that, an option. You have the right to do the trade before the clock runs out, but if the market goes haywire and turns against you, you can simply choose to walk away. To keep it simple in your head, just think of it as a two-sided coin. On one side, we have call options. A call gives you the right to buy. You generally use these when you're feeling bullish, meaning you think the price is going up. On the flip side, we have put options. A put gives you the right to sell. You'd buy a put when you're feeling bearish and expect the price to drop. So calls are for buying, puts are for selling. Let's walk through a call option really quickly. Say a stock is sitting at $100. You think it's going to soar, so instead of spending all that money to buy the stock itself, you just buy a call option. Fast forward and you hit the nail on the head. The stock shoots up. Because your contract lets you buy that now expensive stock at the old, cheaper price, your option becomes incredibly valuable. But here's the catch. If the stock stays flat or drops, that contract just expires. It becomes totally worthless, and you lose the cash you paid for the option. Now let's flip it and look at a put option. Same stock, $100, but this time you think the company is in big trouble. You buy a put. The stock takes a nosedive. Now, because your put option gives you the right to sell that stock at the original higher price, your contract is suddenly worth a lot of money. It's pretty wild. It gives active traders a way to actually make a profit even when the whole market is crashing down around them. Which brings us to part 4. Why do traders actually use these tools? Mainly for speculation, hedging, and income. So yeah, there are 3 main reasons investors use options. First up is speculation. Like we talked about, people place bets on the price going up or down, hoping for way higher returns than normal stock buying. Second is hedging. And honestly, this one is absolutely crucial. Imagine you have this huge stock portfolio and you're worried the market might drop next week. Instead of panic selling everything, you could buy some put options. If the market tanks, your stocks lose value, sure, but your put options gain value, which softens the blow. It acts exactly like an insurance policy for your investments. And third is income generation. This is where the pros use fancy strategies to squeeze extra cash flow out of the stocks they already own. All right, let's get into part 5, risks and common mistakes. Time for a quick reality check. We've got to be super clear here. Derivatives are inherently way riskier than regular stocks. When you buy a stock, you own a piece of a business. There's no expiration date. You can hold it for 50 years if you want. Derivatives, completely different ballgame. First, they use that leverage we talked about, which can amplify our losses painfully fast. Second, they have an expiration date. You are quite literally racing against a ticking clock. Third, the math behind them is much more complex. And finally, the prices move at lightning speed. You can make money fast for sure, but you can also get wiped out before you even know what happened. And that leads right into the classic beginner mistakes. Mistake number 1, trading something you just don't understand because you heard a cool success story online. Mistake number 2, going crazy with leverage and accidentally vaporizing your whole account overnight. And mistake number 3, relying on emotion and treating the market like a casino. These are really powerful tools, but if you let your emotions take the wheel, you are in for a very, very expensive lesson. Let's bring all of this home with a quick summary matrix. You can really see how these stack up. Look at the nature of the assets. Stocks are real ownership. Futures lock you into a future deal. Options give you a choice. Look at the timeline. Stocks last forever. Futures and options both have an expiration date. And their main uses? Stocks are your go-to for long-term investing. Futures are heavy on speculation and risk management. And options give you that amazing flexibility to hedge, generate income, or speculate. So here is the big question I want to leave you with today. Will you invest in your own knowledge before you start risking your real, hard-earned money? Because at the end of the day, out there in the markets, your knowledge isn't just power, it is literally the most valuable asset you can possibly own. We've really only just scratched the surface of all the amazing strategies detailed in our source material today, but I hope this gave you a fantastic foundation. Thanks so much for hanging out with me for this explainer. Keep learning, stay focused out there, and I'll catch you next time.